Let's talk about the statement of cash flows. In my personal opinion, the statement of cash flow is probably the most important statement if you're talking about all of the financial statements. Why? Because it really does explain a lot. It tells you exactly how cash has been used, the inflows, outflows of cash, and explains the net change. And it does give you some idea of why there's this big mix between net income and profitability and cash. It is also a very, very critical statement to help us understand the use of cash and also to be assured that the organization is solvent, can pay its bills. So the statement of cash flows has 3 sections. Has the operating, the investing, and the financing section. What I want to talk about is the conceptual understanding of what the statement of cash flows is and how it is prepared in general terms. I don't want to spend a whole lot of time on all of the detailed information because I believe your reading will help you, and I want you to be able to target your information easily. First, with the operating section, everything to do with the statement of cash flows is about operations and how we're using that money. But we are only concerned about information that has a cash effect. We want to measure how we're using money coming in and how money is used going out. There are 2 ways in order to prepare this operating section of the statement of cash flows, the direct method and the indirect method. On the screen, you're going to talk about the indirect method, and that's going to start with net income. We're going to use net income. Now, net income, as you already know and have learned before, net income is going to be prepared on a accrual basis, and it does not consider cash. It does not make cash its only consideration. But the statement of cash flow is going to have to take that number and convert it to a cash basis. So it's going to remove all non-cash transactions. And on your screen, you're going to see some of the examples of non-cash transactions and what you'll have to do in order to remove those items from the net income So most importantly, you're starting with net income. You're converting it to cash by removing non-cash transactions, and some of which are included in this particular slide. And again, sales or losses or gains, again, these are non-cash transactions, need to be removed from the net income. And here you'll see how to remove them depending on if it's a net gain or a net loss. Investing is going to be talking about long-lived assets. And again, it's going to be cash related. So if you purchased a long-lived asset, and again, you purchased it with a debt instrument, you're not going to see that on the statement of cash flows because, again, we're only concerned about the inflows and outflows of real money. And when we talk about cash, let me back up a minute. When we talk about cash, we're talking about cash and cash equivalents. Okay? Very important, not just money in your money market account, but also in your checking account, also in your payroll account, also your money market accounts, all cash and cash equivalents. And cash equivalent would be something that can be converted to cash within a 90-day period. Very, very important to note. So investing is going to be about long-lived assets and all of those transactions that are cash driven, inflows or outflows. And here we've got some examples of what inflows and outflows and what investing transactions would be in that section. Examples would be what I mean by that. And again, we're talking about all long-lived assets. We're only concerned with long-lived assets, and we're concerned with the cash effect of those long-lived assets. So we're not going to be considering any transaction that has no cash effect. So if you sell an asset, we want to see the cash portion of it. We only care about the cash portion of it. So that's very, very important information. Gains or losses as a result of a sale of assets will not be shown in this section. It will be shown in the operating section of the statement of cash flows. And we talked about that in the previous slide. The financing section is going to be about equity, mostly, and long-term liabilities. So long-term liabilities like a bond, for example. Bonds will be important to note. Long-term obligations is another. The equity section, any changes in the equity section that have a cash effect. That includes common stock, that includes additional paid in capital, that includes dividends and treasury stock. Or change or retained earnings. Again, we're talking cash effect. So when you look at these different sections, the first thing you're going to say is what items go in these sections Again, operating section, anything that relates to profitability of the organization, operations. And if you're using the indirect method, we're going to be starting from net income, and we're going to be adjusting net income to reflect or to remove all non-cash transactions. We talk about the investing section. We're going to be talking about PP&E, long-lived assets, right? Long-lived assets, but only the cash effect of those long-lived assets. And the financing section, we're going to be talking about long-term liabilities and equity. So bonds is one example of a long-term liability, but we don't care about the non-cash effect of it. We only care about the cash. So if it's inflow of cash, outflow of cash, we're concerned about it if it's a liability in this section. And the stockholders' equity, same thing. We're only concerned about the cash aspect of those equity items, including common stock, additional paid-in capital, dividends, and retained earnings, and treasury stock. Now, again, in this section here, it's just giving you some information on how to deal with long-term loans and how those long-term loans in terms of how we add them or subtract them in this section to come up with our change in liability. If we have a change in liability, we have to find out what makes that liability change and what components of that change have a cash effect. So there might be some reconciliation that may be involved in it. We simply want to make certain that any change in cash as it relates to the equity section or the long-term liability section of the balance sheet, we want to make certain that those items are included in the financing section. Now, the question then becomes, what do you do with current liabilities? Well, current liabilities are going to be shown in the operating section of the statement of cash flows. Accounts payable, for example. Wages payable, another example. Okay. Current assets are going to be shown in the operating section. Accounts receivable, meaning if you receive cash from your clients in cash, and any kind of payments to your employees, your long-term, your wages payable, when you pay your debts you pay back your employees for work that they have done. Again, so liabilities on the long-term side are going to be shown in the financing section. Short-term liabilities are going to be shown in the operating section. Short-term or current assets are going to be shown in the operating section of the statement of cash flows, cash portion, of course. And in the investing section is going to show the long-term assets. Obviously, we're only concerned about the cash effect of those transactions. So analyzing cash flows, obviously there's some ratios that you can prepare. And again, we want to show the operating cash ratio, capital expenditure ratio, and free cash flow. All of these ratios it shows and explains how cash is used. It gives you operational efficiency of our cash flow. It gives you the relationship between your expenses or your long-term capital gains or capital asset purchases as it relates to your cash flow. And again, how an organization uses its money, whether or not they'll be solvent, are there going to be some issues of cash flow in the future? Cash flow statement will most certainly give you that information. So, as I said before, thank you very much for listening, and I will talk to you in the next video.